Yep, I see it. You're live.
All right, so we are live, and I'm going to go ahead and kick us off today. So in today's show, we're interviewing Anna Kelly, real estate investor who's created time and money freedom, founder of REI Mom, helping women create a legacy through real estate investing. So Anna, welcome to the show this morning.
Thanks so much, Rachel. I'm happy to be here.
Awesome. Well, Bruce Wayner is with us as well, my co-host, and today is our first time going live on Facebook while we're recording. So welcome to the show, Bruce.
Good morning. I'm really excited to talk to Anna today. She is focused on a particular thing that she wanted into the future, and she made it happen. And I'm particularly interested in her perspective on using leverage to grow this even faster. So this will be for everybody listening here, and have also ever thought about leverage with your real estate. I think she's going to provide some really good insights for that.
Excellent. Well, Anna, as we get into the show today, first tell us a little bit about your background and who you were before real estate investing.
Sure. So again, thank you so much for having me. It is a pleasure to be here. I started out my career in the financial industry. So about 25 years ago, I was in private banking for Bank of America. And so I really started out, focused on investments and, learning about all the traditional investments that, advisors will tell you to invest in: stocks, bonds, mutual funds, annuities, life insurance, et cetera. And from there, one of the takeaways that I had was a lot of my very wealthy clients actually made much better returns in real estate. And so I knew even at a young age that, there's something about real estate. And one day when I have money, I want to learn, how to buy it. So it just put that little bit of a spark in me. So I left Bank of America and went to work for AIG, and I was in a product development group within the life insurance world where we basically did infinite banking type products through private placement, variable life insurance policies, where our high net worth clients would basically bring us their selected hedge fund, and we would custom wrap a life insurance policy around that so that they could invest in what they wanted to and let it grow tax-free forever, and then use the loan component, in infinite banking. So I had a very broad financial background and a pretty good understanding of private placements and things of that nature. But I really wanted to be home with my children. And so even though I had been kind of driven at one point, I had a baby. He just turned 16. And when I was home with him, I really, just desired so much to have that freedom to be able to be home. And we couldn't. We had huge school loans. My husband had just gotten out of chiropractic college. And I was basically the sole, not the sole breadwinner, but after he started his own business, kind of became the sole breadwinner while he was building a business. And real estate was our way to allow me to create enough passive income so that I could stay home with my kids. And I started investing for that reason.
That's very interesting. So it sounds like a combination of factors. So not only do you have this knowledge base, then you also have this personal why that you wanted to be able to be home with your kids and be able to build that financial freedom. That's just fascinating. So that was about 16 years ago?
16 years ago was when we first attempted to go into real estate. We watched a bunch of HGTV while I was at home on maternity leave and bed rest.
Nice.
And we did our first house flip at the end of 2003 in Houston, Texas. And that was my kind of first foray. We had a failed flip, lost a bunch of money, learned a whole lot of valuable lessons, but pretty much at that point realized that flipping wasn't the best option for us. And in 2007, we moved to Pennsylvania with 2 little kids at that point to start my husband's business, because we thought, the W-2 isn't working, well for him as a chiropractor. Let's just be an entrepreneur and we'll have our own business, and that'll create, the financial freedom that we need to allow me to be home with my kids. Well, we did that in 2007, did really well for a year, and then the economy crashed in 2008. And not only did it impact, small town, rural Pennsylvania, lots of layoffs, but people's insurance changed. They couldn't afford to pay, co-pays anymore. They had to pay big deductibles. And I worked for AIG, which was one of the biggest companies that was hit hard during the financial crisis. So thought I was losing my job, lost a significant portion of my 401k. I can't remember if it was 2/3 or 3/4, but it was a lot.
Oh, ouch.
It was tough. And we thought, what are we going to do? Like, I'm about to lose my job. I live in a rural area where I could not likely replace my high dollar income, working for a big major corporation very easily. And so the first thing we did was we bought a 4-unit with a 401k loan, because I thought at least I will have some passive income coming in. And we had already bought a 4-unit to live in that year, because I knew it wasn't wise to buy a house. We're very conservative financially with my financial background and knowing we had all this debt. So we started as landlords just kind of out of necessity to cover our own expenses, just in case, we lost my job and needed to support his. So that started us on the path of eventually realizing we can't rely on a W-2. We can't rely on being entrepreneurs because those businesses can fail. We need to really set ourselves up with true income that can become passive, that we can be in control of, and that we can bank on for years and years and years. And real estate rentals was that for us.
I love that you talk about control and the passive income being more of a fallback on, rather than even just focusing on being a W-2 employee, and even more than just focusing on being an entrepreneur as well. That's fascinating concept there. And then you said that you bought the property, the rental property, investment property, before you bought your own house, right?
Yes, we did.
Yeah, go ahead.
Yeah, we did that, and we did that several times because, my why, like you said, was really important to me. I wanted to be home with those babies, and it seemed like everything that we did financially to set ourselves up to do that just didn't work out the way we thought it would because of the economy and, debt and things like that. And so I wanted so desperately to be home with my kids that I knew, I don't need a house today. I can live in this small box. We sold a huge house in Texas and moved into this little tiny 4-unit apartment building. And then when we outgrew it and we had the third child in 2009, we rented a house for 4 years while I actively bought rental property instead. So it was easier for us to rent a really nice house than to put a bunch of down payment money on a house when we could use that to buy investment properties.
I love just even hearing you talk about that, thinking outside the box, because I think so many times we can get caught in this American dream thing where we say, well, I've got to have the house, I've got to have the cars, I've got to have the job, I've got to have all the trappings of a successful life. And really, you just said, hey, look, it's not really about the outward appearance. It's about actually making the money and actually building passive income through assets. And I love that you really just put all of your heart and soul into building that.
Yeah. And, I think, Rachel, even though we know, if we really think about money, we realize it's unwise, as newly married people, to buy a big house and to get a fancy car and to, go into all this debt. It's kind of the pressure of this American dream. And we learned the hard way by buying a house and getting a car with a 6-figure school loan, that as soon as one person loses a job, you're in trouble. And then the economy collapses at times that you don't suspect. And, we didn't know anything about market cycles and real estate cycles, and that we were kind of at the top of the market and about to lose our shirts. And we also went into all this debt to, the dream of being business owners. And all of that taught us so many hard lessons and kept me from being home with my kids so much earlier, because we did go down that path. And then we realized, wait a second, we know this isn't the wise thing to do. Let's reset and rebuild it the right way.
I love that. Now, was your husband on board with those decisions? Was he helping make decisions along with you? How did that look?
Yes, initially, yes. But it's interesting how two people get together that are completely different and complete opposites.
Yes, and I should have prefaced my question, because I think a lot of times there can be differences of opinion, even within a married couple. You could say, well, this is my priorities, but here's my priorities over here, and not necessarily are they always aligned. And I was just curious how you navigated that.
Sure. So we both wanted me to be home with my children. That was important to both of us. We just felt like that was the best thing, to give those kids the foundation of their mom at home. And because of all the debt that we started out with, it wasn't possible. And so we both had that shared vision. And as a chiropractor, a lot of people don't know this, but when doctors come out of school, they basically work for like $30,000 a year. And he wasn't working seeing patients. He was working being a gopher and drumming up business and being a marketing person. And he wasn't taught marketing and finance and running a business. He was only taught how to see patients. So as soon as he got out of school, he was doing something that he didn't enjoy. He got laid off twice because he didn't bring in enough new business, twice in like 2 years. And we finally said, this isn't going to work. You should work for yourself. And that's the way that I can be home. So moving here, I moved from Houston, Texas, where all of my family is, to rural Pennsylvania. I really did it, even though I was afraid to kind of start over, really to support his business so that I could be home with my kids. So we were on the same page about the move. We were on the same page that we needed to be careful with our money, given what we had been through. I didn't tell you that too, that during that flip was the second layoff. So we had 2 mortgages, a car payment, a school loan, and 1 job. And so we both realized, we need to reset. And the smart thing to do was buy a building for his practice instead of lease, buy a 4-unit for us to live in. And then when we panicked in late 08, early 09, when all this stuff happened, we knew rental real estate is something that can help us. So we were on the same page for the first 3. During that time, it was really difficult because we were trying to keep his business afloat. My job was very demanding. And even though I worked from home, I couldn't have the kids home with me. They were at my mother-in-law's, and we had, kid stuff in the evenings. And then we started having problems happen with these 12 units. So we had to learn together to be landlords. And I couldn't, swing a hammer. I could paint, but it basically fell on him to do the work, because at the time we had no money and lots of debt, hundreds of thousands in debt. So we couldn't really afford to hire other people to do it. So he didn't like, of course, that he had to learn to be Mr. Fix-It and replace those and, do plumbing and electrical while he's trying to run a business. So there was a little bit of tension, like, why did we do this? I'm like, honey, trust me, this is the wise financial thing to do. So, it took a while for us to get on the same page. And every time I wanted to buy more, he was like, oh gosh, it's one more thing I have to do. So it's definitely a matter of us having to trust each other and work with each other, for the bigger vision, knowing that a few years of really tough blood, sweat, and tears active income was eventually going to lead it to be very passive. So we just worked through it together.
So Anna, talk through your thought process into financial services, because there's a lot of really good things that you were saying there, but they also were timing directed. So example, when you first got into this idea that you wanted to purchase, it was pre-2008. And you probably were able to do some of the things you were able to do because the lending requirements were a lot looser. So that was advantageous. But being advantageous, though, then got you to actually purchase more things that you probably should have. And that put more stress into it, but it also made it easier for you to get into it. Then you used your, I'm going to ramble here on a bunch of things that you said. Then you used your 401k, which is self-directed, which was out of necessity at that time. And yet a lot of people would, and I want to get your take on this. A lot of people, including Rachel and I, would say that should be the last place you should get, just simply because the tax benefits aren't there for the self-directed. So if you can do it any other way, that would be better. And then you grew your empire, let's call it, through trial and error. And now you're out there teaching people so that they don't have to go through the same trial and error, but they don't have this. But they don't have the same kind of lending, the loose lending that you had. So all those things. What could you comment on all that?
Sure. So, I think lending actually right now is still fairly loose, given the top of the market cycle where I think we are. Is if you have decent credit and a good job, lending is available. And what I'm starting to see, Bruce, is a lot of these more creative lending offers coming out, not necessarily from the big players, but people, when real estate gets hot, and lending is competitive, you start to see lenders do some crazy things again, like 100% financing, 100% HELOCs, those kind of things. And so I think we're kind of heading back toward that loose lending. I think when we hit a recession again, maybe in the next year, 18 months or so, things are going to tighten up again. But to your point, when we moved to Pennsylvania, when we bought our very first building, it was my husband's office. So we were looking at leasing space, and leases were extremely expensive. And we saw a building for sale that had tenants with it. So it had 2 units on top of the practice and some tenants behind us. And I thought, it'd be much cheaper when I ran the numbers for us to own this, because the tenants are helping to pay that mortgage, than for us to lease space. And when you talk about loose lending, so we were moving to PA. The regional bank knew that I might be losing my job and we were starting a business. They gave me a 90% LTV loan on that commercial space and let me open a 10% credit card to put the whole other 10% on.
Whoa.
So I got 100% financing on that building. Now, we overpaid because we were at the top of the market and we didn't realize it. It was '07. And then the 4 unit a year later, I was able to get in with like 3%. We did FHA as an owner occupied. So those, we got into before the crash, right before the crash. But the lending on that building, we really had no place to own, $400,000+ building. Also starting up a business with another $300,000 in business startup debt. So we started in '07, I kid you not, over $700,000 of new debt with a new entrepreneur and someone who worked for a company that may not let her work from home. It wasn't wise on our part or on the bank's part. But again, when you're in these cycles and these upward markets, everyone thinks this is going to last forever. The economy's going great. Nothing's going to happen. And you don't realize that you're at the precipice of disaster financially. And so I've learned to be very, very cautious with leverage. I utilize leverage only for real estate investing when I can buy assets with leverage that pay my liabilities and then some. But I am very much against any other type of consumer debt, over leveraging yourself just because the loans are available, because we learned the lesson the hard way that we got in not only not knowing about economic cycles, but way over our heads in debt.
I think it's interesting that you mention debt, leverage, arbitrage. I mean, the whole idea of being able to use a liability to then create cash flow and income, if you're in a position where you're not going backwards or going negative, or you're using that liability or a credit card to buy some, Kiyosaki would call it a doodad, right? In the cash flow game, it would be this thing that is just to boost your lifestyle today. I mean, that is definitely not a wise move, but when you're using leverage to create cash flow, that is a good move. And I really love that you also said you made some mistakes. You went through this time that you're over $700,000 in debt at this point. How did you go then from there? And honestly, there's so many threads that we can pull from this, because I think there's still pieces that Bruce pulled into the conversation that we want to come back to. But how did you go from that position to where you are today? Kind of track us through that journey and what that looked like.
Sure. And on that way, I just want to make one quick note that I forgot to mention, Bruce, about the 401k. So my 401k was an employer plan, but I had the ability to borrow from that plan. So I didn't withdraw.
Okay.
I didn't withdraw the $50K. I could borrow up to $50,000, and it was like 3.25% or 3.5% interest. So I borrowed it to buy a 4-unit building and was paying myself back the interest. So I didn't have the big tax hit. And quite frankly, it was our only option. Like, I knew I'm going to lose my job. I've already lost 2/3 of this thing, ballpark. And I need something that can bring me $1,000 a month so we can eat and pay for gas. So it was my last resort. I didn't have any other cash, and I had a lot of leverage. And so I think when you're in that kind of situation, those things are designed for an emergency, unless it's an infinite banking plan and you're using it for leverage on purpose. And so I used it to my advantage in an emergency. So just wanted to say that when you talk about getting,
and you're highly resourceful with that as well. I mean, let's just point out here, you didn't go take a loan from your 401k so that you could eat. You chose to create this asset to produce income so that you could be in a position where you could create cash flow from that asset. And I think there's a huge difference between borrowing from the 401k to put food on the table directly, or creating that asset that's going to put food on the table.
For sure. And I'm so thankful. I read some books as I started to buy the first property that what my husband was going to practice in, about making money and rentals and buying rental property for extra income. And they really showed me like what was possible with, buying with leverage and creating that cash flow and then raising the values and cashing out and doing it again and again. So I had just read a couple of books that helped me to think through that properly. And right afterwards, I thought, if I could just buy another one. AIG basically told us, brace yourselves. Many of you may lose your jobs. You'll have some kind of package. And I had been there a while, so I was just kind of hoping that when I got laid off, I'd get a package that could sustain us for a while. And I could try to accumulate some more rental properties to bridge the gap between maybe what my new salary would be with some other employer here versus what I was making. So I tried to keep buying property. But right after that, the lending really tightened, as many of you know. And so I tried to get loans. But number one, I worked for AIG, and the whole world saw AIG on the news every day. So they saw there were layoffs. They saw we were in a very creative unit, and none of the banks would approve me for a loan. So I'm like, I know what this plan is. It's a wise move. I'm not buying a car. But they just saw, $700,000 of debt for your spouse, a job with AIG that's probably going under. There's no way they would lend me money. And so it took me 5 years to really find another way when the banks were still saying no. And basically, eventually, I got so tired over 5 years of working full time, still trying to keep my husband's business afloat. We were dealing with these 12 tenants, and we did one by one, knowing that even though we couldn't buy more now, we could keep raising the value of the units we had and keep raising the rents. And so we just focused on those 12 units for those 5 years. I had another baby. So I was, at this point, 4 kids 5 years ago. And I said, I've got to find another way. I've got to find ways to buy property with creative financing and owner financing. And I knew that owners that finance properties could defer their capital gains taxes. So if I could just find the right owners and research it and explain to them the benefits of owner financing, maybe I could keep buying. And I went back to a real estate meeting. I hadn't been to any local REIA groups in years. And I went to one and met a guy who wanted to sell a property, a multi-unit in my area. And I asked him if he would be interested in talking about selling on terms, and he said yes. So I saw the property, another 4-unit building, had lunch with him, made an offer, we worked it out, and I bought a 4-unit on owner financing. And when I did that, it gave me the confidence to say, you know what, I can keep doing this and I can keep growing. And that was about 2 weeks after AIG, after all these years, said finally, okay, it's our turn. Our division's going to be sold. So all of you need to pretty much be prepared within a year to lose your jobs. And that kind of pushed me to say, I really have to do this now. And, my kids were growing, and all those years of wanting to be home were kind of not happening. So I went down that path, and I actually bought another 4-unit the next month, word of mouth, for another retiring landlord that wanted to save on capital gains, called me, and we were able to make a deal. And then I partnered with somebody to buy another 4-unit. And once I had another 12 units within about 3 or 4 months, I went back to my banks who had said no. And my regional lender who had given me the very first loan in 2007, the 90% loan, I said, look, I've paid faithfully. We are in a much better position now. I have all these units. Will you please give me an equity loan or an equity line of credit? And I will only use it to buy more rental property. And they finally said, yes, you've done a good job. And once I had that 5 years ago, I knew that I could scale this thing very quickly with the wise use of leverage, only buying income producing properties to get to where I needed to be.
That's fascinating. And I really appreciate how you led us through that journey, because I think it's easy for somebody to look at someone like you and say, okay, well, she's in a position where she is financially free now. She's reached that time and money freedom. And I want you to talk about that a little bit too. How, right now you're in a position where you have not had to work in that job with AIG anymore. You're in a position where you've accomplished that dream of being able to be home with your kids. And it's easy to look at that and just think, oh, it must have been easy for her. And you clearly went through a lot of bumps and dips and hardship and challenges and hard decisions. And even just the 5 years of having to prove yourself so that you could come back to the bank and obtain that financing that you knew you were capable of using well, but they didn't know that. And so, just as you are sharing this journey, it's easy, I think, for people to say it must have been easy for her. And it's clearly not. And I love that you're sharing the hardships and the real lessons.
Yeah, thank you. And that's so important for me, and the reason that I do these types of things and post on Facebook, because all people really hear is buy property and you'll get rich. And the reality is it's not that easy. So many things are outside of your control. The economy, lending, your job, your family dynamic, if you're young in your young 20s and maybe you don't have any kids and one spouse can support you, sure, you can have a much easier path. But the realities of life make it such that you've got lots of challenges against you, and you just have to figure out a way. How can I get creative if I want something badly enough? How can I get creative and make it happen, even when nothing else seems to work out? So, 5 years ago when I bought those 3 4-unit buildings and the bank started to say yes, basically, Rachel, I just created a plan and said, I have to keep investing locally because at this point I had 4 kids, still helping with my husband's business, still working, and they started getting very active in sports and things like that. So I knew I had to buy local. We just had to keep with the same plan, what had worked with us. We'd buy 4-unit apartment buildings. We bought a couple singles that we bought at foreclosures that we knew we could make them, worth about $50K more. And in a couple months, I could take $40K out as a second mortgage and use that to buy another 4-unit building. So we just created a plan to buy 12 units a year over the next 4 years. And I knew that if I did that, I would be able to bring in about $150,000 a year passive in my rental income. And that would be enough for me to be home. So I just went methodically on that plan of, 12 units a year, 4 years. And 4 years in, I realized doing a financial statement that, oh my goodness, I'm actually a multimillionaire on paper. I still didn't feel like that because I'm still living check to check with my AIG income and putting everything we made in these buildings back into buying more. We didn't take anything out of that income. Everything we made, it just went to saving up enough down payment for the next one. And so, the last year, basically I knew, okay, now I've got enough to replace my income, but I had some lines of credit and business credit cards that I used very strategically and carefully at 0% to do the repairs on the units and then pay them off as soon as I got a second mortgage and then started over again. But I needed to pay off about $200,000 in debt before I felt comfortable quitting my job and retiring. And so I bought a big multifamily last December with 2 partners and learned about, partnerships and syndication. And that was enough for me with the acquisition fee to pay down half of that debt. I actually sold 3 of my units because I knew I could make $100,000 on them and I needed that cash to be able to safely retire. And then I retired in May. And, now that we gave up one income, it has not felt any different because I just started living on the rental income where before we were living on the W-2 and reinvesting the rental income. But, 5 years later, I was able to retire, with a strong 6-figure income, multimillionaire, and just pinching myself like, how did this happen? It seems so slow and so hard, but we got here. And now that I have been able to retire and really give it my full-time focus during the day while my kids are in school, I have significantly increased my portfolio where now I have ownership, as a general partner in almost 500 doors, and I'm asset managing like $52 million in real estate. It's just been incredible.
Hey, two things. You probably haven't listened to our podcast, but our listeners know that there's a couple of things that we kind of cringe. You use the word retirement, which is your prerogative to use, but to me, you didn't retire. You just left the job.
Yes.
The other thing is this idea of passive income. That's the proper term, but it's not really passive. I mean, you're working on this every single day, and you've worked on all that time before, those 16 years before, to produce this kind of income, which we call, for whatever reason, passive income.
Right.
And there's nothing passive about it.
Correct. And I think that's so important for people to understand that, for most of us, 80% of the population or more is not independently wealthy and financially free. And so most of us that are trying to build passive income from rentals, it's built on literally, I say, the blood, sweat, and tears of active income. It takes years of active income to get it to the point that it's passive. Now, so I own 70 units, my husband and I together, that just us own with no partnership. And for those 70, because we redid them the right way, we totally redid those units, they are really pretty passive for us at this point because not much goes wrong. We have like a 2% vacancy rate in our area. We have a very low supply for our demand, and we have above average income earners living in our apartments. So there's very little turnover, very little maintenance issues, and it can truly become significantly passive, although not completely passive. Buying these bigger ones, again, right now I'm putting in a lot of time during the day to find deals, finance the deals, syndicate the deals, and then, getting big chunks of cash for putting those things together, and then having income, from those bigger properties that will last probably somewhere between 3 and 10 years, depending on the strategy for these bigger properties. But it will become much more passive for me once the deal's put together than it is up front. So, that word retirement, again, like I wanted to be home with my kids so badly. And the reality is now they're all old enough to be in school. They're between 8 and 16. So now I have a choice during the day. If I never did another deal, Bruce, I really could say I'm just totally retired. I am just doing whatever I want during the 8 hours a day my kids are in school. But I have a choice, and I feel like a privilege and responsibility to do greater things with my time now that I'm not working a W-2, to say, what else can I do and still be able to have financial freedom enough that I can control my day. And at 3:05, when my kids walk through the door, I'm not working. Unless there's an emergency, I'm wife and mom and enjoying my evenings. And what I've built on the side has allowed me to have that choice, whether I want to work during the day and keep growing this thing or not.
Yeah, that's wonderful. I mean, that's exactly what we try to preach, is that you're not really trying to retire in other words, build up a mound of money and then try to draw off of it. What you're trying to do is build up cash flow so that it gives you the time and money freedom to do the things that you want. That's true financial freedom.
Exactly.
A lot of people think financial freedom is, I'm going to build this big mound of cash, and then supposedly I'm going to take 4% off of this for the rest of my life and never run out of it. And of course, you've shared with our listeners, and we've said this before, but it's always great, unsolicited. You shared that you lost somewhere between 2/3 and 3/4 of your money. And so it's we always talk about real estate, could go down, and it does go down, except people have to live somewhere. So it's the cash flow that's still important off those real estate properties.
Yeah, and I think another distinction that people are really surprised to hear me say, as someone who was trained as a financial advisor and told people stocks, bonds, mutual funds, get that it used to be 8 to 10%. Now it's like 4 to 6 if you're lucky. But the reality is real estate has a real value. There's true intrinsic value in property and in real estate, and especially in multifamily real estate, even more so than necessarily single family. But the stock market is primarily not valued on its intrinsic value of the book value of that company. It's valued based on consumer sentiment. And so if you look at the stock market right now, the price per share of stock is well over what the price per share of stock should be if you look at their PE ratio. And so we are really at risk by putting all of our money in the stock market right now, thinking, oh, things are never going to crash. It's just going to keep on going. And the reality is when most of the stock market is overvalued, then as soon as consumer sentiment starts to freak out a little bit, like we're seeing right now with all these yield curve inversions, people start to panic and sell. And then they're going to panic and sell, and they're going to lose their shirts. And so I have been completely out of the stock market personally for 18 months because I just feel like it is not a good place to represent real value that I can bank on that 4, 6, 8%, whatever they want to say it is, because I see that a correction has to happen, not only because of where we are in the cycle, but because of the fact that it truly is overvalued right now. So I would much rather bank on some level of control in where I invest my real estate in a way that its values are not likely to be hit significantly than I would give up complete control just because my financial advisor says, oh, it goes in cycles, just don't touch it, you'll be okay. If you have to touch it right now when it's getting ready to go down because you're about to retire, you could lose your shirt and not be able to retire. And I saw it happen to my grandparents, before the last crash, retiring right before that and losing hundreds of thousands of dollars in the stock market.
Yeah,
Absolutely.
it's all about time horizons. People always they don't understand this. I don't know if you know this, Anna, but I am a financial advisor, and people talk about this all the time. They're just like, well, over the last 50 years, but it's that 50 years may not be your time horizon. It may be over the next 20 years, and that's going to be completely different. And I do believe we're at the top of a cycle. Maybe not the very top. Who knows?
Right.
But the fact of the matter is, you see things that are indicating that, and one is a little bit easier lending. I went to a talk last Tuesday by Manny Menton Bedos, who's the editor of The Economist magazine, and she says one of the things that you can actually notice at the top of cycles is that every financial institution starts saying things are easy, like we can get you this easy loan, this stock's going to easy, you can't lose on this, you can't, so on and so forth. And then I heard somebody, I won't mention the major wirehouse because I don't want to put anybody down, but the president of a major wirehouse just the other day said, I know that the yield curve has inverted, or the last 10 times that the yield curve inverted, we had a recession in the next 18 months, but I really think it's different this time. And
they said that last time too.
Exactly. Now talk a little bit about, because I listened to you on another podcast about your thinking that has changed from like D plus, C minus properties to more of that B property, and how you came about it with the school districts and so on and so forth.
Sure. So one of the important things that I just mentioned is that although real estate values can also go up and down, there are certain types of properties that are just more resilient during any point in the economy. And I started out buying in an area that was like a Class B area. So when we look at properties, especially commercial properties, multifamily, we typically say there's A, B, C, and D properties and A, B, C, and D areas. So the A areas are like brand spanking new, really big builds. D is a war zone, drugs, gang activity, robberies. You don't want to live in a D zone. You want to live in an A zone. But most people can afford to live in a B or C class area. So your B class area might be your above median income people, a lot of millennials who can't quite afford the brand new building with all the bells and whistles, but they're making good income and they want a nice property and they want to be near jobs and near shopping and restaurants and things like that. So that's going to be like a Class B area. And then you've got your C, which people, have a broad range of C, but it's basically where the average American person, lives, like median income, maybe just below median income, but decent school districts. B, or you're going to be really good school districts, and A, maybe even better. And so I did a little experiment. I really invested primarily in Class B to C plus area, really close to where I live, within about 15 minutes. And by investing in those areas, my tenant pool are really strong tenants. They're not going to destroy the property. The property values stay pretty stable. They're well maintained. People want to keep the sense of a well-maintained property. I have doctors, I have interns, I have nurses, I have leaders at major like Hershey, the Hershey factory and the Reese's plant, and really high dollar earners that live in most of my buildings, and they stay a long time. So the values of those properties between 2007 and now have not gone down. My rents haven't gone down. So they weathered the recession really well. And even though we had some layoffs in our area, when you're dealing with Class B to even C plus areas, we had the best school districts, the two best school districts in our entire region. And so if people lose jobs, they may downsize into an older apartment to have a lower rent, but they're going to do whatever they can to stay in that nice area to keep their kids in those schools. And so those types of properties just are kind of a sweet spot for me, where the rental income is really good, the property values maintain themselves, and the tenant pool is really strong and wants to stay. And I also have really good supply-demand balance. So there's not a lot of supply in my area. It's hard to get new building permits. And so I, just offer a slightly nicer product than what the average does in my area, and I keep tenants a really long time. I had a small experiment because my goal, remember, was cash flow. All I cared about primarily was I need to replace my income and be home with my babies. I knew I needed to think about the long-term value of assets and buy things that were fairly easy to manage given that we were self-managing. But I was willing to take a gamble on going into a C- area. And I invested about 20 minutes from here in an area that, wasn't quite D war zone, but the tenants did not have like sustainable jobs. Most of them might work at, a cleaning company or at a mall or at a grocery store, and not good school districts, rated maybe 2 or 3 out of 10. But I could buy a 3-unit where it would cost me $150,000 to $175,000 to buy a 3-unit in my town. I bought a 3-unit for $75,000, and the rents weren't significantly lower than the rents that I was already getting here. So I thought, how bad can this be? I will just hire a property management company so I don't have to drive there, because I wouldn't want my kids sitting there in the car by themselves while I'm in the property. It's just that kind of area that I felt just not quite safe enough. If you don't feel safe to, lock your doors and keep your kids in the car, that's a C-D area. And my husband was like, I am not managing property there. So if you're going to buy it, that's fine, but you're going to hire a property manager. And we had more trouble and more issues meeting our business plan with those 3 units. And then I did the same thing with a single family. I bought it for $30,000. It was worth $90,000, and I got like $900 a month in rent. So I thought, man, cash flow is king. A year in, they couldn't keep tenants. Tenants didn't want to stay because of problems with their neighbors or losing their jobs or drug activity, wanting their kids out of the schools. They destroyed the properties, skipped town, couldn't pay rent, and even the property management company just couldn't keep them filled. So while on paper, the business plan looked really great, when you're in areas where people don't want to live, can't afford to live, and don't have good school districts, you're basically creating a business plan relying on people who can't pay, which is just the wise thing to do. So I learned very quickly, this is not good, and I would rather cash out now, also thinking we were near the top of a cycle and needing that money, and just cut my losses and not invest in those areas anymore. And so thankfully, in a year and a half, not quite a year and a half, I made $100,000 on that 3-unit and that single family house because I bought them so well. And I was able to sell to other investors who are desperate to get in the game and will overpay in an area that they shouldn't. So it was an experiment. I learned very quickly that I didn't like that experiment, at least not for my model. And now I am investing primarily only in Class B areas or Class A areas with buildings that were built somewhere between, 1980 and, 10 years old.
So it's interesting as you're talking about this because there's more to the picture than just cash flow, right? I mean, you could say, well, yeah, on paper, cash flow looked like it was going to be the ideal case here, but you have to understand the big picture and understand not only the class of the neighborhood, but the type of people. And you said you were not going into it for the purpose of appreciation, but because of how you bought the property, that ended up being a play that was in your favor that you then had cash to be able to use in another situation. And it's just interesting how you're pulling all of these threads together because it's not a one size fits all. It's not like, here's the one formula, apply this one mathematical formula to all the rental properties, and all of a sudden you're in a position where now we know exactly how you're going to achieve financial freedom in 25 years. You really need to be in a position where you're understanding and building your knowledge. And it sounds like you've always been this learner that you were willing to say, okay, how can we learn how to do property management? How can we learn how to invest? How can we learn how to do this new thing? And I think that just growth mindset that you had even helped you to be able to understand the big picture as you're investing.
Sure. And I think too, starting out, with a financial advisor mindset, I really was always thinking about, when you have money and as you grow money, you need to focus on, income, growth, and preservation. And so I knew with every investment, all 3 of those things were important. But at different phases of your life, one of those things may be much more important to you than the other. So as we were growing income, because I wanted to be home with my kids, that was my primary focus. Yet I still knew that I needed to buy things and the types of real estate that I could bank on not losing my shirt, preserving the value and having properties that were going to go up in value. So this little bit of a stray really wasn't like I'm going to go all that way, but I had enough that I was willing to say, let me take a chance on a few that are just income. And then I realized the headache of the income wasn't worth the fact that the properties were going to go down in value, probably weren't going to appreciate much longer. But I think that's really important, is that as you go in different phases, the type of investor you are changes. And even for us now that we have, a lot more than what we need coming in, I'm not as concerned with cash flow. I still want the cash flow, but not at the sacrifice of my time. So in the beginning, I was all for cash flow, but I had to put in all my time because I didn't have any money. Now I've got time and a lot more money. So I'd rather invest in things that are going to give me some cash flow, but that I know can weather this next recession pretty well to preserve my capital and eventually go back up in value.
Hey, Anna, we have a tagline that says, model the successful few and build a business and life that you love. And so from your financial advising background, you actually modeled the successful few.
Yes.
And then you've actually mentioned using infinite banking, and that these really successful people used it. We actually espouse infinite banking, and we practice it, and we teach it to people. And the thing that comes out all the time, people say, well, if this is so great, why haven't I heard about it? And the fact of the matter is, it's been around for quite a while, even when they didn't call it infinite banking.
Mm-hmm.
People were using their life insurance policies. So what have you learned? The single most important thing do you think you have learned from modeling the successful few?
I think just learning how to master money so that money doesn't master you. We are not taught in our education system really strong financial fundamentals. We are taught,
amen to that,
learn your stuff, get a good degree, and go make money, work for 30 or 40 years, and one day you'll retire. Buy a house, you deserve it. Buy a car, you deserve it. Live the American dream. We're not taught, the use of debt and what it can do to us and how much interest we're paying. We're not taught the wise use of debt. So, in everything, even going through my training as a financial advisor, I didn't learn about real estate. I only learned about basics of, here's how you slowly grow the retirement plan of the American dream. And if you have money, here's the things that you can invest in to make a different return. No one ever taught me, how do you master money? How do you use debt wisely? What kind of debt should you not use? What do market cycles look like? None of these things are really taught. And so I knew that what I was trying to do, the way that I had been taught, wasn't working. And I needed to learn more about money and my options. And I just started studying. And so, like you said, Buffett says, when people are frantic, that's when you buy. When people are, all happy, that's when you sell. And so just learning basic fundamentals of the market and how to use money to grow wealth is something super important that I don't see in our American education system.
I completely agree. And I think just the emphasis on cash flow and having tangible, actual physical assets that you have the ability to get cash flow from or sell is completely different, as you were talking about, from the paper market and just having your money in stocks, bonds, and mutual funds. And so you've said the word control probably, 10 times during this show here. And that's really what we're talking about as well. It's so important to be in a position where you have cash flow from the money that you're making, from your active income. You have money that you're not spending at all. You're your cost of living is less than what you make. So you have that cash flow gap. Then you're putting that cash flow to work to generate and create cash flowing assets. And so it's just interesting to hear whenever, I guess the reason that we even do this podcast to begin with is that there's so many people who want to be financially free, but there's so much misinformation about creating retirement and financial freedom in the world that most people don't actually know how to go through doing that. And so it's just really awesome to be able to learn from people like yourself who have walked through that journey and followed that path. And so I wanted to then ask you, because as we talk about in our cash flow system, it's more than just becoming financially free. It's about having time and money freedom and then creating a legacy and having your greatest contribution, you're giving back. And you're not only investing yourself. I want to ask you kind of a multifaceted question. I want to know what you're looking for today, because you're not just investing for yourself, you're taking other investors along on this journey with you. And then I know you're giving back as well through REI Mom, and then another mastermind as well that I'd like you to talk about, and just kind of why you've decided to be a giver of this knowledge and insight, and not just say, hey, I've done it myself and now I'm going to, just kick back and relax.
Sure. So, the REI Mom and, some of my coaching and a local women's real estate group that I have really are around that exact desire, just to help people to understand that this is not a pipe dream, that real estate really is one of the greatest wealth builders and wealth preservers of any investment available to us. And it's not just for the ultra wealthy. If someone like myself, who I grew up in Section 8 housing in apartments, had no one to tell me about money, could become financially free and independently wealthy through real estate the hard way, I know anybody can do it if you will just educate yourself and actually take action daily and take any bumps in the road that come, because many will, and just keep with your plan. Just keep going, get creative, figure out another way to do it. But there is nothing like real estate to get people out of the cycle of, being a slave to the American dream, if you can even achieve the American dream, and really realizing, what true freedom is about, financial freedom, time freedom, really just through educating yourself and taking action and modeling others. And so that's been my desire to give back. And now that I have the time freedom of not working, all day during the day for another company, I have some time that I can, spend pouring into other people and just teaching them, to do what I've done.
That's awesome. And I want to thank you for that contribution. Thank you for being willing to be on our show. Thank you for sharing your knowledge and wisdom with people in general. And so what is it that you're looking for in terms of new investments right now? And then we'll find out how people can follow you if they want to find out more.
Great. So primarily I'm focused on multifamily housing right now, primarily because it's where I have the most knowledge and understanding of the market and its impact. But I really view myself as an income stream investor. So anything that I can find, like self-storage, for example, in the right areas and the right market saturation, there's all kinds of caveats, but things like self-storage where you can have cash flow, you can have some tax benefits, you can have the equity appreciation, leverage, all of those things. I'm interested in those niches as well, but it's just kind of taking one thing at a time. So as I focus on multifamily, I take the chunks of cash that I make through acquisition fees and through my monthly income, and I'm looking to deploy it into other investments and other sectors that have very similar fundamentals within real estate. Primarily, I'm focused on multifamily investing for my own portfolio with JV partners here locally, where we have better reach and better saturation to get better off-market deals and create some economies of scale. And we're looking in Class B, Class A areas for slightly older buildings. And then in my syndication model, we're doing the same thing, but just not here in PA. So we're looking at certain markets where we feel the supply-demand fundamentals are really good, that the long-term economics of the area are really strong, even if we head into a recession. And we're primarily looking for assets where we are not overpaying like the rest of the world is. We're not looking for A, B plus assets over 150 unit, because we're competing with hedge funds and institutions who are trying to park their money in a safe place during a recession. So they're overpaying, by
that's exactly right,
for these big properties. So we're looking to find properties just under their radar, where there's not a ton of competition, where we can go in and buy a little older, rougher building that we know has potential to raise rents even in a recession. And so I'm looking, more for asset preservation and appreciation than necessarily cash flow over this next couple of years in those really nice areas that I think are going to weather the storm better than some other areas.
That's excellent. And I just really appreciate you sharing not only what you're looking for, but who you are as a person. I think it's just really interesting to see the journey that you've gone on and all of the lessons that you've learned as a result of that, and how you're able to create the wealth that you are today. So if somebody is wanting to reach out to you, whether for coaching or to understand real estate investing better, or to partner with you on any deals, how do they find and follow you and learn more about you?
Sure. So on Facebook, you can find me there, Anna, REI Mom Kelly. I have a Facebook group called Creating Real Estate Wealth That Lasts with REI Mom. And my email is info@reimom.com.
Excellent. Well, we'll make sure that we have those links in the show notes to this podcast as well as that goes live. And so thank you so much for sharing just your abundance of wealth and wisdom with us today on the Money Advantage podcast. We sincerely appreciate you and your time today.
Yeah, thank you, Anna.
Thank you so much. I appreciate being here.
In closing, remember, success leaves clues. So model the successful few, not the crowd, and build a life and business that you love.